Are you currently experiencing high mortgage payments?
Have you heard about the lowering of rates in the market?
Then why are you still paying such a high monthly installment?
If you want to find out how you can save on your monthly installments in terms of interest, be sure to check out this video. Welcome to another episode of RealtySense with Hendrik and
Xing En?
So today we're actually doing a video on what is home loan refinancing. Why we are doing this video actually is also in response to how interest rates environment have changed over the past few months.
Yep.
And also we've been receiving quite a number of client inquiries on, Hendrik and Xing En, is it actually the right time to do our home loan refinancing now? I'm seeing, rates have really lowered. Okay. The purpose of this video is actually to go through this and to provide you some clarity and to understand what home loan refinancing is about. Okay. So I think what a lot of our clients have seen on the news is, Singapore banks have already lowered their rates. US also lowered their rates and all this. But I think what I want to say here before we deep dive into this video is interest rate environments can change, and it can change very fast. What I mean by this, you look at this news article from 16 April 2024. That was last year.
Yeah.
We are filming this in 2025, January. So April last year. Look at, this is an article from CNA. Homeowners likely to pay higher mortgage rates for a while more, right? Then you go and see the inside of the article. Mortgage rates are currently as high as 4%. Then an expected dip in interest rates is only likely to take place at the end of next year.
Yeah. So
Next
this
year
will
means
end.
2025 lah. Now is January. You say end 2025. So, okay, what I'm trying to say over here is I'm not trying to laugh at any journalist or any financial analyst. But what I'm trying to say is no one truly has a crystal ball on how interest rates will move. But I think what we can speak about is what is in the present. So in the present, rates have already fallen. By how much? We'll cover in this video. But, because of how interest rates have fallen, Singapore banks have already seen increase in their refinancing numbers lah. All right. So what has happened in the US? US has already cut interest rates 3 times since September. 0.5% in September, 0.25% in November, and another 0.25% in December. So 3 rate cuts since September, total of 1%. All right. But what does this mean for Singapore? All right. So a lot of people, they have this notion that Singapore's interest rates and the US interest rates are very correlated. This is true, but not one for one.
Yeah.
What I mean by this, so US, they use interest rates as a form of monetary policy to manage inflation. Singapore, we also want to manage inflation, but our central bank, MAS, we don't manage inflation by interest rates. So I want to debunk this very huge myth that every time people on the street, they like to say, wow, US cut interest rate already. Our Singapore government also should cut interest rates. But that's not how it works.
That's not the case.
How it works, Singapore, we don't control interest rates. This is very clear. We do not control interest rates. But how we manage inflation is by the use of our exchange rate. I don't want to deep dive into this as this is not an economics lesson, but Singapore, we don't manage interest rates. We don't fix interest rates. So you don't expect MAS to come out and say, interest rate will come down by X percentage by when. Okay, that's not how it works. But in fact, earlier I said, there is strong correlation between the US rates and Singapore's rates. But it's not a 1-for-1.
Yeah.
US already cut 1%. But Singapore, did we follow exactly 1%? No. But what I can say and what I can share over here that is an extract from MAS is currently US rate is still near 5%, right? But Singapore and US interest rates, there tends to be a gap. It's not a 1-for-1, right? So if it was a 1-for-1 when US cut by 1%, Singapore would have also cut 1%, but that was not the case. So what happens is, usually, Singapore's interest rate and the US interest rate, we will see a gap, a discount by what we mean. So if US is this rate, Singapore would tend to be lower. Why so? Is because there is that expectation that the Sing dollar will appreciate against other currencies. So a lower rate in Singapore is actually accepted, right? So perhaps Xing En can share one of our current clients' case on, this is a client that actually reached out to us. He come and tell us, Hendrik, I see this news article telling me, hey, home loan rates now 2.45% already. Then I log into my bank app. Why is it telling me I'm paying 3.9769%. Right. Last thing I can bring you through some numbers.
As Hendrik has mentioned earlier, these are numbers from our client, and he has actually just provided us with this number about 2 days ago. So it's very recent numbers.
As of now, it's still January 2025. So very recent.
Yeah.
I mean, we're hoping to upload this video quickly, but these are very recent numbers. Yeah.
So he has actually an interest rate about 3.9769%, about 4%, and a loan on a loan remaining of 697,000.
700.
About 700,000, and this means his monthly mortgage is about 3.3k. Okay, so why is our client here paying a rate of 3.9769% when the news has actually stated that the interest rate has gone down to about 2.45 to 2.5? Actually, our client is on the floating rate home loan package,
And what you see on the news, 2.4, 2.5, or it depends lah. But these rates are quoted as fixed rates.
So how the interest rate is actually calculated for a floating home loan package is based on the 3-month SORA rate. So SORA is actually just the Singapore overnight rate average, but it's just more simply put the cost of interbank borrowing. So now the 3-month SORA rate as of currently is about 3.3%. We just use the 3-month SORA rate, which is 3.3% as of now, and add a bank spread, which is a premium that bank charge you to earn money, right? So it's about 0.5% to 0.65, and so you'll get an estimated of 3.95 as your interest rate if you are on the floating home loan package.
But we also see the SORA start trending down. So, these numbers will change. But what we're trying to convey over here is the way these type of things are calculated remains the same. That's why we say that this video will remain evergreen, right? Regardless of how rates will change in the next 6 months or 1 year or years down the road, the rationale and the methodology behind this remains the same. So this is going to be an evergreen video, right? So Jing mentioned there is the floating rate, but what is also in the market?
Yeah, fixed rate, right? So the other form of a loan package that we have on the market is actually the fixed rate. So how are fixed rate actually calculated? Actually, there's no really a calculation. It's actually just given to you as a net figure. So now we can see how the fixed loan rate for fixed rate packages have actually trended. So as of June 2023, we can see that it was just slightly above 3.6%. But as of now, January 2025 is actually at 2.6%.
About like what you saw earlier in the headline news that I shared, we already see some rates of 2.45, 2.5%. But I want to cover it very clearly. There's so many banks in Singapore doing mortgage, and you don't look at the numbers just based off the headline news, right? You can inquire with us. I mean, we can get you updated rates from the different banks. But I think what I want to say very clearly is the rates that you pay and the rates that another person pay can be different. Why so? Different loan quantum, different type of package, different time you sign the loan, and so forth. But what we see on this chart over here is generally fixed loan rates now are at about 2.6%. So, but that's the average. You may get a better rate from another bank, you may get a higher rate from another bank. That's what we're trying to say. So throughout the whole of this video, since the start, Jingen and I, we have been talking about refinancing. But what exactly is refinancing? And are you even eligible to refinance in the first place? I think this is the part that we want to cover on that. So to make things simple for you to understand, look at this cartoon character over here. His name is Ahwat, okay? He's our client, for example, right? So typical homeowner, borrower, most people have a home loan mortgage. What happens? So refinancing is when you have an existing home loan, you take it to another bank, and the other bank takes over this home loan package. What happens? For example, I want to be very clear, this is just an example. I'm not saying DBS is quoting these rates or OCBC is quoting these rates currently. If you want to know the exact rates that what is in the market out there currently and what's applicable to you, maybe just contact us over here and we can hopefully bring some clarity to you on this matter. But for example, Ahwat over here, who has currently a 1 mil outstanding home loan with DBS, for example, currently paying the floating rate, near 4%, agak 4%. So he say, hey, I tahan this 4% already. I cannot accept this anymore. I want to move on. I want to take this to another bank. You can, as long as you're out of your lock-in period. So he takes this home loan, bring it to OCBC, and maybe this bank offers him a fixed rate of 2.55%. Then he may enjoy some savings by doing this refinancing. But so this is what refinancing is. But are you eligible to refinance? Can you refinance? It depends on whether you still are within your lock-in period. If you are outside of your lock-in period already, then it makes sense to do that. So back to my client's case, right? This is his figures. So let's look at the fine print of his figures and how to look at the lock-in period. But if you're very unfamiliar as to how your lock-in period works and when is it, perhaps you just drop us a text. We'll be very happy to clarify that for you and try to figure that out for you. Because if that is the case, then you should really reconsider whether it's the time to refinance. But look at my client's case over here. First 12 months, he's on a floating rate package. So first 12 months, 0.6% plus SORA. Quite normal lah. Second year, also plus 0.6%. Third year, 1%. Wow, we song already. Why higher? So at this time, maybe he's already out of his lock-in period. He can consider to go outside to shop for new loan packages already. But I tell you the worst part. After the third year, 1% above 3 months SORA, thereafter lah. So it continues and continues. So, I'm going to ask you, if you are not very financially savvy, you don't know whether to go for fixed rate or you don't know whether to go for floating rate, but you are already out of your lock-in period, should you refinance?
Yeah, definitely.
Why?
Right.
Because 1% versus 0.6%. Why you want to pay higher? When you have, the door is open, literally the door is open for you to go outside and choose another bank. Then you should refinance. Why you stay on this kind, why you stay on this 1% package? And I tell you the funny story is, some people don't know what refinancing is. They don't know what repricing is. So I have this real client story who I sold his condo about 1 or 2 years back. But he bought this condo in the early 2000s, about 2003, 2004. Stayed in it for 20 years. He bought it as a new launch. Then when he bought this as a new launch, I won't mention he take the loan from which bank. But when he buy this home, he take the home loan package. He paid, the floating rate package, he paid this. But after the lock-in period, he continued paying. He never refinanced. He don't know what refinancing is. And he only found out when I share the type of sharing that I'm doing on this video. Then he's asking me, Hendrik, why I never meet you earlier? Because why have I been paying extra percentages of bank spread?
Can say so much more.
When you could have saved much more by considering to refinance. And this is not 1-2 years, almost 20 years. Then he realized this. So what I'm trying to encourage the public or anyone watching this video is, number one thing is, if you're out of your lock-in period already, okay, you're not very financially savvy, you don't know which home loan package to go for, also no reason to pay higher than necessary bank spreads, right?
Okay, so now let's look at some numbers using our client's case that we have shared previously. So he's currently on a floating rate package with the interest rate being the 3 months SORA plus 0.6%. So he has an interest of close to 4% and with his monthly payment about 3.3 K. So our client actually hasn't refinanced yet. So he's actually looking out for options, and so this is what his figures will look like before refinancing. So after refinancing, how would they actually look like?
So we've been shopping in the market for him, and what we see in the market is now fixed rates, right? It's actually rather interesting. Rather than you being quoted a net figure for both year 1 and year 2, what we actually see is there is this what we know as the step down package. So year 1, what we were quoted was 2.6%, and for year 2, 2.38%. So this is actually appealing for some people. Why? Because some people say, hey, I want fixed rate, but I don't want to lugi if rates come down further. So actually this factors this in already. You're paying 2.6% for the first year. Second year, you're only paying 2.38%. And I think what at least this provides some certainty to your monthly payments. So maybe Jing can show how the monthly payments will look like if our client actually go for such a package.
So actually, if you do take on this package of a fixed rate step down interest rate package, right? So for year 1, the interest rate will be 2.6%. So that actually draws down his monthly installment to 2768.29, which is almost a $600 decrease in their monthly installment, and 600 monthly, and that will be a lot for the entire year, right? So for the second year, actually the interest rate will be 2.38%, even lower than the first year. So then that will also mean a lower monthly installment, so at about 2690. So we can see that if our client do choose to refinance using this package, he can actually benefit a lot from this decrease in monthly installment that he has to pay.
And that's just the monthly installment alone. I think shortly we'll cover on actually the benefit is beyond the monthly installment difference itself.
So what you see on this slide is actually a more in-depth figure of the calculations that we have done previously. So this is on outstanding loan of about 700K. But in today's context, is an outstanding loan of 700K really realistic?
Actually, it can be. But it really depends on the type of client and what property are they mortgaged on, right? If it's for a lower quantum property, then I would say 700K fair, right? But in the market, let's say very typical private property household, if you bought a resale private property, 3-bedder in like past 1 or 2 years, or you buy a, let's say a new launch 2-bedder, your home loan may be in the range of over $1 million.
Yeah.
Why? Because 3-bedder in OCR, I'm talking about 1.4, 1.5 million already. 75% LTV,
About 1 million.
1 million home loan already, right? So let's paint that situation and that scenario of a $1 million home loan. How would that look like?
Mm-hmm. So same situation as before refinancing on a floating home loan package, which with a interest rate of 3.98%. So you have an outstanding loan of 1 million. So that will actually bring your monthly installment to about 4.7 K a month, right? But then after refinancing, using the step down package that we have seen earlier, the first year interest rate 2.6, you'll get the monthly installment of $4,000. So you're actually getting 700 savings, $700 in your monthly installment savings. And then for the second year with a lower interest rate, you are actually saving more. So you're actually paying about 3.9K, so about $100 lesser than the first year.
Yeah.
Yeah.
So we've been focusing on what the difference in
Mhm.
monthly installment figures is over here. But I want to be very clear about this. Actually, this is how the numbers work. I think too common in the market when people talk about refinancing, they just talk about the raw difference in their monthly installment. But I encourage you, actually, why not look at the numbers in detail? It's actually a lot more than that, right? What we see over here for $1 million home loan, savings of monthly installment about $700.
Yeah.
But look at the difference. I'm putting these numbers into greater detail over here, right? So 3.98% down to 2.6%. Okay, I'll just take the first year as a reference. Second year, you save even more, right? Because 2.38%. But let's look at the numbers. Fixed rate. So every month, your monthly installment is the same one. 4.7K over here, 4K over here after refinancing, right? But when you look at how mortgage installments work, every month you pay this amount of money to the bank, it's actually two different types of payments. You don't know but
Yeah.
if you look into the fine print, you do some calculation, you will know, right? How much is principal? How much is interest, right? Let me be very clear. Interest is an expense. You pay it to the bank, is their profit, right? Principal is your own money. What this means, example, next time you want to sell this property down the road, every time they ask you, how much is your outstanding loan? Your principal reduces your outstanding loan. So when you pay more principal, you're paying more money towards your own pocket. So is it good or bad thing?
Yeah, definitely good.
So we aim to pay high principal. But when we do refinancing, when you have a lowering of rates from 3.98% down to 2.6%, look at this. Principal before refinancing, 1.4K, thereabout, right? After refinancing, I lower my rate, but my principal payment go up. Then now I look at interest. 3.3K before refinancing, but after refinancing, I'm paying about 2.1K. So you realize there's two benefits over here. Number one, my principal payments go up. Number two, my interest payments goes down. So look at it. Just now we say savings was about how much? $700 in monthly installment. $700, let's be clear, $700 monthly installment difference. But you look at the interest, 3.3K versus 2.1K interest.
Yeah, about
That is almost 1.15, 1.2.
Yeah, 1.2K.
It's more than your monthly installment difference. And your principal, you're paying more towards yourself also. From 1.4 to 1.8, that's about $400 difference. So to us, how we say it, please look beyond your monthly installment difference. If we look into the principal and interest, it makes absolute sense, right? When you refinance, you're paying more towards yourself, less to the bank. As simple as that.
So previously we mentioned that of a home loan of about 1 million, and we can see that actually the benefits are actually very good, right? But what if you have a higher home loan outstanding? Let's say you live in a bigger condo or like you live in a private property. So we can see that if you have a 2 mil home loan, the monthly installment will drop from 9.5K to about 8K. So a monthly savings of 1,500. But now, as Hendrik has mentioned previously, we want to look at the principal and interest portion of this monthly installment. Where are they going, right? Where's your money going? So we can see that if before refinancing, if you're on a high interest rate package, let's say on a floating rate package, you're
For 2 years?
yeah, over 2 years, you're actually the amount that you're paying towards your principal is actually 72K. But then after refinancing, the total interest, the total principal that you are actually paying is actually 92K. So that's about 20K going into your property instead of as interest to the bank.
To your own
Yeah.
equity. That what we call equity. Meaning it's like your own
Mm-hmm.
money in the property itself.
Yeah.
Right?
Mm-hmm. But now let's look at the interest. So before refinancing, we can see that the interest is about 156K towards the bank. But then after refinancing, we can see that you are only paying 97,000 towards the bank. About 60K. Yeah, you're saving that amount instead of paying that towards the bank. You're actually going. The money is actually going
Yep.
towards your property.
Yep.
Mm-hmm.
So the math has it that as long as the property loan outstanding is larger, whatever benefits that you see from refinancing, whatever benefits, it will be amplified. So it does not mean that you have a small home loan, you don't consider refinancing. You should still, right? But to really look at the calculations and the numbers, I think it will be good if you contact us via WhatsApp over here. We have this calculator that we have developed using our Excel, and it clearly shows what is your interest and what is your principal payments, the difference in the interest rates that you pay, your monthly installments. It will be a good way to get you a snapshot of how things will change if you refinance. Because even if you have a small home loan, it doesn't mean you don't refinance. More often than not, the numbers will still make sense. So I think if you contact us, it will be a good way. It's a free consultation. So happy to provide you clarity on this, and you can understand better whether it even makes sense or not.
Okay, so in this video, we covered a lot about floating rate, fixed rate. So Hendrik, I just want to ask you one question. For anyone watching this video, what would you recommend them?
I think this question, there's no perfect answer. I mean, I'm not a financial advisor, neither are you. But I think what we want to be clear is whichever package you go for, there will be savings for you as long as you're out of your lock-in period. Because if you're out of your lock-in period and you did not do anything about it, you're already paying higher rates.
Yeah.
So if you do not have a specific direction, whether you want to go for floating or fixed, as long as you're out of your lock-in, you need to do something about it, right? But back on, you ask me, fixed or floating, it depends on your expectations really. What I mean by this, put it simply, if you expect rates to come down fast and significantly, then you go for floating, because you can capture the drop in the floating rate. But if you expect rates to hold out for longer, or won't come down soon, or come down a little bit only, then maybe you may want to go for a fixed rate lah. But I must also say, fixed or floating also depends on the type of person you are, what type of appetite you have. Because fixed, what at least it offers is there's certainty, and a certainty in the payments. You're not like taking a bet. You're assured that this is the rate you'll be paying for the next 1 or 2 years. But when it comes to floating, you really be following the market lor. If the rates go up, similarly your mortgage payments will go up. If the rates go down, if there is significant lowering, then you enjoy the benefits. At the end of the day, I think even professionals in the market, or who are financial professionals, they can be wrong about interest rates. So I cannot commit to a specific direction of what interest rates will be like in the next 1 or 2 years. But I think the general sentiment is interest rates should lower. But also from the Federal Reserve itself, they have already signaled rate cuts may slow in 2025 itself. So at the end of the day, clients and home loan borrowers, you have to make your own decision and your own expectation of how home loan rates will go. But I think what we want to convey to you is, as long as you're out of a lock-in period, I think it's seriously time to look into whether it's time to refinance. And very happy to help you all to perhaps do a health check on what your home loan currently is. We'll be able to advise whether there are better packages out there in the market and it's time to refinance. So with that, I think that's how we'll end this video. And thank you very much for spending time with us at Get RealtySense with Hendrik and
Thank you.